Global quantitative finance governs trillions of dollars in capital, optimizing yield and measuring risk in a fraction of a second. To manage this capital, institutions build elaborate risk models. And while proprietary, enterprise-grade risk engines exist, the default platform for prototyping, internal validation, and daily risk management remains Microsoft Excel. But Excel is a pure calculator. It executes mathematical logic flawlessly, yet it possesses zero capacity to verify if the economic assumptions fed into it actually mirror reality. The clearest example of this vulnerability is the standard value at risk model. Value at risk, or VAR, is a statistical technique used to estimate the maximum potential loss a portfolio could face over a specific timeframe. To calculate VAR quickly, the industry often defaults to assuming that financial variables follow a normal distribution. Analysts compute baseline metrics, deriving the average expected return and using Excel's sample standard deviation function, stdev.s, to measure volatility. Relying exclusively on these descriptive statistics creates a false sense of security. Because a normal distribution is perfectly symmetrical, it is entirely blind to extreme, asymmetric tail events, the rare but devastating losses that cluster at the far ends of the curve. Markets do not behave symmetrically. A sudden economic shock can instantly invalidate the assumption that asset prices will remain stable and predictable. When that market shock hits, the parametric model fails. The smooth bell curve shatters, exposing the jagged, fat-tailed empirical reality underneath. Assuming financial variables are stationary and normally distributed is a statistical shortcut. In dynamic markets, this approach drives model failure and leaves institutions without the capital buffers required to absorb sudden volatility. Consider a portfolio of BBB-rated corporate bonds. A risk team needs to model the value at risk based on historical yield spreads. The baseline model assumes these bond spreads will fluctuate according to a standard normal distribution. Calculating standard variance metrics without verifying the actual shape of the historical data is dangerous. A standard deviation figure cannot tell you if the losses are evenly distributed across the timeline. To verify the shape, we must run an empirical validation. This chart shows a frequency distribution built from 750 discrete daily bond observations, with a smooth, theoretical normal probability line overlaid on top. If the normal assumption were true, the bars would fit neatly under the curve. Instead, we see a distinct visual gap in the upper right tail. The actual extreme loss events far exceed what the smooth curve predicts, forming a U-shaped error curve. The data reveals a concentrated cluster of severe loss events occurring specifically in the 3.8 to 4.2% spread range. Excel provides built-in diagnostics to detect this mathematical invisibility. We run the skew and curt functions directly on the dataset. The skew function returns a positive number. In finance, a positive right skew indicates a higher frequency of large losses compared to large gains. The curt function measures kurtosis, or tail heaviness. A normal distribution has a kurtosis of exactly 3. Our result flashes well above 3, proving that this dataset has fat tails. Extreme events occur far more often than a Gaussian bell curve allows. Trusting the parametric VAR in this scenario underestimates extreme loss. The normal distribution predicts safety in the exact statistical region where empirical reality guarantees exposure. This symmetric assumption also breaks down in asset pricing. Imagine a stock currently trading at 100 United Arab Emirates dirhams. The portfolio manager expects an 8% annualized return and assigns the asset a 25% volatility overlay. If we apply a standard normal distribution to model this asset's future price, we introduce a critical mathematical flaw. This chart shows the error. Asset prices are bounded by 0. A stock price cannot drop into negative territory. Yet a symmetric bell curve mapped over these prices improperly bleeds right past the 0 bound. To fix this, the calculation must migrate to Excel's lognorm.dist function. The lognormal distribution properly models the compounded, non-negative nature of returns. Notice how the curve shrinks sharply away from the 0 line and stretches out to the right. By making this correction, the calculated probability of a downside breach drops. The left tail is thinner, revealing a more accurate view of downside risk. Applying the wrong distributional shape misprices downside risk. Theoretical elegance must always yield to economic reality. Static assumptions also fail across time. Consider a pension fund tracking sovereign bond returns. The fund calculates its regulatory capital buffer using a standard deviation derived from a 10-year historical dataset. Then, the central bank enacts an unexpected 150 basis point rate hike. A basis point is 1/100th of a percentage point. This aggressive hike triggers a regime shift, a sudden change in market behavior. This chart shows the problem. The 10-year historical average acts as a mathematical anchor, drawing a flat, stable line. But juxtaposed against it is a 30-day volatility spike, jumping 59% above that long-term baseline. To survive regime shifts, the Excel model requires dynamic structural overlays that adapt to recent data. By combining the offset function with stdev.s, we create a responsive 30-day rolling metric. This formula dynamically tracks and traces the localized volatility spike as it happens. Without these dynamic, time-sensitive overlays, risk models will silently and systematically undercapitalize institutions during regime shifts. Statistical flaws compromise the math, but the physical architecture of the spreadsheet poses an entirely separate operational threat. This introduces the concept of silent model drift. Model drift occurs when an analytical tool gradually falls out of alignment with the external environment it was built to measure. We see this clearly in liquidity management, specifically when banks calculate their liquidity coverage ratio. The LCR is a metric ensuring institutions hold enough highly liquid assets to survive a short-term stress scenario. Suppose global regulators update the Basel rules, reclassifying certain corporate bonds so they no longer qualify as high-quality liquid assets. And here lies Excel's greatest operational vulnerability. When embedded economic assumptions expire, the spreadsheet does not crash. It throws no error codes. It simply keeps calculating. Because of this drift, one institution's model silently continued operating under the old rules, which overstated their available liquidity by 12%. This silent error fed directly into board-level reports, prompting premature dividend payouts and distorting the bank's true capital allocation strategy. A spreadsheet's infinite flexibility becomes a source of systemic fragility without the rigorous enforcement of rule updates. This is why international regulatory frameworks, like Basel and IFRS 9, issue uncompromising mandates regarding model governance and drift prevention. To pass a supervisory audit, an Excel model requires absolute segregation into distinct functional layers. This diagram shows a standard grid exploding into an isometric 3D model, splitting into a yellow inputs layer, a gray logic layer, and a green outputs layer. The inputs layer must utilize strict data validation rules to prevent users from entering physically impossible parameters. The logic layer must be strictly protected. Computation cells are locked, and hard-coded numbers are eliminated from the formulas. Furthermore, raw cell coordinates must be replaced. As the padlocks engage here, the raw formula transforms into clear, auditable named ranges. The final operational requirement is an immutable audit trail to track versionings and unauthorized modifications. Using VBA macros, the spreadsheet automatically logs every action. This audit log captures the exact username, timestamp, and parameter override in real time as the model runs. True financial modeling requires marrying statistical skepticism with unyielding structural discipline. A model that cannot be challenged, audited, and empirically validated represents a significant institutional risk.